Hey everyone, welcome back to Straw Hat Loots. Today we're doing something different. We've all heard about investing in stocks, crypto, and trading card games, but what actually happens when you compare them side by side? No hype, no bias, just real numbers and what they mean for your money. We're going to look at three simple benchmarks: S&P 500 for stocks, Bitcoin for crypto, and for TCGs, we'll use some liquid products such as seal boxes from Pokémon. So, my goal today isn't to tell you what to invest in, it's to show you what actually happened over the past few years, including during pandemic crash, so you can make your own informed decision. Let's go. First, let's look at the actual returns. If you put 1000 bucks into each of these in early 2020, here's where you'd be today. Stocks, represented by the S&P 500, turned that 1000 bucks into around 1928. That's a 16% average annual gain over 5 years. Solid, steady growth. This is why your parents and grandparents trust stocks. Crypto, using Bitcoin as our benchmark, took that same 1000 bucks on a roller coaster ride. It crashed to 474 in March 2020, shot up to over 2,800 in 2021. Today it sits around 8,261. So, despite the heart attacks, that's a 126% average annual return over 5 years. Now, TCGs. Due to limited data, I was only able to trace the pricing back to November 2021. But if you bought Pokemon Team Up Booster Box in November 2021, based on pricecharting.com, that 1000 bucks would be worth around $13,000 today. That's around 300% average annual return. It's unfortunate OPCG didn't exist 5 years ago, or we should be seeing similar returns. Before you get excited about TCGs, and I know some of you are already thinking about your collection, we need to look at the other side of returns, which is risk. Because higher returns usually comes with higher risk, right? So let's talk about what happens when market crash. March 2020, the world shuts down, panic everywhere. Stocks drop around 33% in 1 month. Your 1000 bucks became 675 overnight. Painful, but stocks recovered within 6 months. Bitcoin got absolutely destroyed. It dropped 65% from its peak. Your 1000 bucks became 474. It also took around half a year to recover, but with significantly higher volatility. But here's where TCG surprised everyone. While stocks and crypto were crashing, sealed Pokemon boxes actually went up 15 to 20% during March 2020. And One Piece again wasn't around yet, but when it launched in 2022, it caught a wave of people rediscovering collectibles. So why? Because when everything feels uncertain, people turn to things that they can hold in their hands, like gold for example, or things with emotional value, things that remind them of better times. That's not financial analysis, that's simply human behavior. And in today's world, nostalgia itself has become a valuable asset class, so people are literally paying premiums for pieces from their childhood. And this is where correlation matters as well. While stocks and crypto move together during the crash, TCGs show negative correlation. They move in the opposite direction. So this makes TCGs a powerful hedge against both traditional market crashes and crypto meltdowns. But let's be real about TCG risks as well. Unlike stocks with instant execution and crypto that trades 24/7, TCGs have their own challenges. You need time to find buyers, you need to understand the market, and you need to deal with shippings and insurance, and there are times you'll have to sell at a discount. So liquidity matters, and TCG aren't as liquid as the other two. But here's what makes TCG fundamentally different from stocks and crypto, and why they have a natural safety net that the others don't. So, in stocks and crypto, every single holder is a potential seller. When panic hits, everyone sells. There's no loyalty, there's no emotional connection beyond price. But in TCGs, something unique happens. A portion of collectors, I would say around 30 to 40%, will never sell their cards, no matter the price and no matter what's happening in the market. So try to think about it. How many stock investors would turn down a 2x offer for their shares? I can assure you, almost none. You won't find any. But TCG collectors do this all the time. 2 weeks ago, I offered my 7,000 bucks Black Label Wave 1 Nami or a 2,000 bucks One Piece slab in order to complete my OPO2 leader set. And I was turned down. Why? Because many collectors hold sentimental values towards their collections. This creates what I call the collector floor effect, a permanent floor under prices that stocks and crypto simply don't have. Even during bad times, there is always a baseless of demand because so many cards are essentially removed from the market forever. So what does this mean for you? If you're building a portfolio, think about what each asset brings to the table. Stocks give you steady, long-term growth with high liquidity and the most history. Crypto gives you asymmetric upside potential with 24/7 access, but with extremely high volatility and risk, which requires strong emotional discipline to trade. Whereas TCGs give you strong, steady returns, crisis resilience with no liquidation panic, there is emotional value, and that powerful collector flow effect, which complements the other two as a strong hedge. So I would say the smartest approach isn't picking one over the others. It's more like understanding how they work together. TCGs aren't a replacement for your core investments, but it can be a huge, powerful diversifier that actually performs when everything else is crashing. So remember, this isn't financial advice. Don't YOLO your rent money into cards. But if you already enjoy collecting, whether if it's Pokemon, One Piece, or other TCGs, understand that your hobby has legitimate investment characteristics that stocks and crypto simply cannot replicate. If you found this helpful, give it a thumbs up and subscribe for more honest comparisons like this. Until next time, this is Strawhead Lutz.